Hello, good morning, everybody, and welcome to our webinar today on value-added tax, which has been introduced through the issuance of the Sultani Decree 121/2020 as part of the new laws and measures and regulations that have been introduced and taken by Oman government in order to find other sources of, of income and finance here in the country. By way of an introduction, my name is Ahmed Al-Barwani. I am the head of Oman office, and together with the head of tax, Shiraz Khan, my colleague, we are going to give you a presentation on the value-added tax, which hopefully will be implemented in 6 months' time as stipulated in the VAT law, along with the implementing regulations which will be issued within these 6 months as provided for in the law. You may post any questions during the presentation so that we can discuss them after we finish the webinar. Please, Shiraz, you can go ahead and start the presentation. Thank you.
Thank you, Ahmed, for the introduction. Good morning, everyone. As Ahmed said, I'm the head of tax for Al Tamimi across the Middle East. And we're just going to, given that the VAT law has now been published in Oman, we're going to give you a broad flavor of what the VAT law involves. So if you just move on to the next slide, please, Joe. So I'm initially going to give you an introduction of why VAT has been introduced in the GCC and in particular in Oman, before I go on to talk about the legal framework of VAT in Oman. It's important to understand. And then I'm going to talk about some of the basics of VAT, which will be important for you to understand, because many people, they don't know how VAT works. They think VAT is a corporate tax, whereas VAT is actually very different. And then I'm going to talk about the VAT regime in Oman, some specific aspects. Obviously, the regulations haven't yet been issued, so a lot of detail remains to be seen. But I'll cover a few sort of key points emerging from the law, which was recently published. And then I'll talk about the impact of VAT on businesses in Oman, before I go on to conclude with the key lessons which have been learned from VAT implementation in UAE, Saudi, and Bahrain. I think the purpose of this presentation is primarily to give you a high-level overview, because obviously we're still a good 6 months away from implementation of VAT in Oman. So there's still some time to go. But so the purpose today was just to give you some key areas you should be thinking about, rather than going into detail through the law. And of course, the regulations haven't been published yet. So that's something we'll perhaps do in another session, in another seminar. But for now, I'll just focus on the key aspects. So just move on to the next slide, please, Joe. Now, in terms of the introduction of VAT in Oman and the region, sorry, there's a question that's just come through, but if you could keep asking the questions, and obviously we're going to have a Q&A session at the end, so I'll come on to the questions, and hopefully we'll have plenty of time to go through most of the questions. And if any questions we can't answer, we'll try to get back to you by way of email. So in terms of the drivers behind VAT in the GCC, I think the seeds for this were sown a long time ago. Everything started, in 2008, 2009, where the whole tax world actually changed. So around 2008, 2009, as you will recall, there was a global recession going on. And many countries, they got together and they started to look at the international tax rules. Because if there's a recession going on, governments are in budget deficit, a lot of countries rely on tax as a main source of revenue. And it's very important. And at that time, when the countries were in budget deficit, they needed more money. Tax was a natural sort of next step in terms of how to generate more money. So they realized at that time that, the international tax rules were out of date. Many companies were using these tax rules to actually pay less tax. Because there were double tax treaties, which are agreements between two countries. The purpose of these agreements is to eliminate double taxation, but many companies were using these same agreements to not pay tax in any country. So many global multinationals were moving money from high tax jurisdictions to low tax jurisdictions, and therefore paying very, very minimal tax. So the G20 got together and they approached the OECD at that time and they said something needs to be done about this. And the OECD started off a project which was known as the BEPS project, base erosion and profit shifting. And under this project, they were essentially focusing on areas which countries need to address in order to minimize and eradicate base erosion and profit shifting. So they came out with 15 action points. There's been other tax developments as well, the importance of transparency and information exchange. For example, there was some legislation in the US called FATCA legislation requiring banks to disclose details of US citizens or US taxpayers to US tax authorities. And if they didn't, they'd be hit with a withholding tax. Common reporting standard, which was fairly similar to FATCA as well, requiring information exchange between tax authorities. But overall, there's been a lot of focus on tax, and tax is now increasingly becoming a boardroom issue, over the past years. And in times where there's recession, generally what you see is countries want to attract foreign investment, so the corporate tax rates go down and indirect taxes increase in addition to the rates. Now, even before VAT was introduced, because in fact, VAT was first discussed in the region around 2004, 2005, if not sooner. But at that time, there wasn't really any incentive for these GCC countries to introduce VAT, and the general economic situation was very, very good. And over time, International Monetary Fund recommended to the GCC countries that they should diversify their revenue away from hydrocarbons, and they could potentially generate between 1% and 2% of the GDP through a VAT if it was to be introduced. But in this region, generally, four countries have had like a full-fledged corporate tax, Oman being one of them, in addition to Qatar, Saudi, and Kuwait. However, generally, there's been limited taxes, no personal income tax. Previously, there was no indirect tax, lots of free zones. So there was lots of incentives operating here, and people living here. But there was some discussion that the VAT would help diversifying the revenue, and that's why it was under consideration. But ultimately, it wasn't the pressure from IMF or all the international discussion. It was actually the regional situation with the oil and gas prices going down, which actually encouraged the region to actually consider introducing a value-added tax. To effectively diversify the revenues, move away from hydrocarbons, and expand the revenue generation, and also to fund public expenses, like hospitals, education, roads, infrastructure. All of this requires money, and these world-class public services that the GCC countries offer, and therefore they need funding for that. And if the money, the revenue from oil and gas is going down, they need alternative ways to generate revenue. There was a number of tax options which was considered. VAT was one of them. Obviously, corporate tax is already there in Oman, and the other one, which was an option, was sales tax. Now, sales tax and value-added tax are fairly similar. Value-added tax is a tax on the value added at each chain of the supply chain, each stage of the supply chain, whereas sales tax is normally a single stage tax. So, for example, if you go to the US, you buy some goods, and then you have to pay sales tax on top of that. And generally, some states have sales tax. Most of them have it. Some of them don't. There's different rates. The way sales tax works as well, generally it applies to the supply of a product. In some states, it also applies to all services unless exempt. In other cases, it applies to specific services. Whereas value-added tax generally applies to the supply of all goods and services, unless it's exempt or zero rated, which is the exception. VAT is also a popular tax as well. It's very, very efficient. The onus to collect the tax is on the taxpayer. The tax authority just has to collect it. They collect it on a periodic basis. You don't have to wait all the way to the end. So at each stage of the supply chain, you're able to collect the tax. And it's also investment neutral. As I was saying, corporate tax actually hits your bottom line. It affects your profits. Whereas value-added tax is intended to be a tax which businesses collect rather than pay on their profits. Also, VAT, it's not a new tax. It's already been there for a long time. Initially, it was introduced in France in the 1950s. Now it's there in place in over more than 160 or 170 countries worldwide. In some countries, it's known as GST. goods services tax, and in some countries it's known as sales tax, but it's all the same. It's a tax on the supply of goods and services. A lot of people ask the question, where is the GCC VAT system taken from? The easy answer is it's based on the European VAT system. There's a European directive, which all European countries have subscribed to. And in the same way as you have a GCC here, there's a customs union in Europe as well. It's fairly similar to Europe, but at the same time, it takes some aspects from the more recent Asian GST systems, which are more simple. They have like a single rate. There's limited exceptions, whereas in Europe, there's lots of exemptions, and it's very, very complicated. Even in one country, you might have multiple rates, and those rates are different in other countries, and there's different exemptions, so it can get fairly complicated. If you move on to the next slide, please. Now, the status of VAT implementation in the GCC, as you know, in Oman, the VAT legislation has been published, and the VAT implementation date has actually been set. So the VAT legislation was published, the law only so far was published on the 18th of October. The law will be effective on 16th of April 2021, within 180 days of the law being published in the official gazette. Already UAE, Saudi Arabia and Bahrain have implemented VAT, with UAE and Saudi implementing it on the 1st of January 2018 and Bahrain following on the 1st of January 2019. So initially there was 2 states which were required to go ahead in order for the GCC agreement to be effective. And those countries were UAE and Saudi. Bahrain followed, and Qatar at the moment, there's still no announcement in terms of when VAT is going to be introduced. In Kuwait previously, the parliament had announced that VAT would be postponed until 2021. And there's been no further announcement, but the expectation is that it's going to be further postponed. If you could move on to the next slide, please. Now, in terms of how VAT is going to work in Oman, of course, you need a tax authority to actually enforce the law, to collect the tax, to apply the provisions in the law, and to generally manage the application and enforcement of VAT. And obviously, Oman already has a tax authority, unlike Bahrain and UAE, for example, which had to set up a tax authority from the beginning because they never had a tax authority before. So Oman already has the tax authority, and that will be responsible for the collection of VAT in addition to the corporate income tax, which is applicable currently. Now, in terms of where the framework of VAT comes in place in Oman, of course, the local law and regulations will be based on the GCC VAT treaty or GCC VAT agreement. This VAT agreement is a country-level agreement between all 6 GCC countries where they've agreed to implement VAT, and also the common principles which will be applied in countries. In certain cases, certain things have been fixed. For example, the registration threshold and the VAT rate. In other cases, for example, there may be some discretion for the individual countries to adopt something different. So the VAT agreement or the VAT treatment sets this out. But the intention was that all 6 countries agree to this VAT agreement, and Bahrain was the last country on the 2nd of February 2017 to do so. So therefore, this agreement came into force. And then each country has to enact its local law and regulations. Now, of course, Oman has already published the VAT law, which has some detail, very little detail. A lot of the detail which will follow in the regulations, which will contain the detailed application of the Oman VAT law. A lot of people think that, when the VAT law is there, the regulations is there, everything is perfect and, you have all the answers. It's actually far from it. Although Oman's had a tax law for quite some time, the introduction of VAT is going to be challenging on the part of the tax authorities and also on the part of the taxpayer as well. It's going to be a new law, new regime, so there will be some uncertainty naturally. Over time, Omani tax authorities will issue guidance. As things develop, the practice, the precedent will be in place. The tax authority may also issue rulings over time to give certainty. But at the very beginning, there will be some uncertainty. And obviously, you could draw to some of the examples in other VAT regimes across the region and globally, but it doesn't always work that way. So if we move on to the next slide. Now, just to illustrate some of the uncertainty which may be there, I think I have two really good quotes, which are my favorite quotes for tax, actually. The first one is, in this world, nothing can be said to be certain except death and taxes. So tax is a certainty alongside death. Everyone has to die one day. And also by Albert Einstein, the hardest thing to understand is income tax. And obviously Albert Einstein passed away in the 50s, which is around the same time VAT was introduced, but I'm sure if he was around, he'd say the same thing about VAT. Now I have some pictures here. You're probably thinking, what's the significance of these pictures? But these pictures actually, each of these pictures it relates to a case law, which were applied. The first two cases were heard in the UK, and the third one was heard in Ireland very, very recently. So the first one, I don't know if you guys are familiar with Jaffa cakes. Basically, as you could see, it looks a little bit like a biscuit. It has orange filling in the center, and then it has some pastry at the bottom. And the question was whether this is actually cake or a biscuit. And the reason why this was important, if it was a cake, it wouldn't be subject to VAT in the UK. On the other hand, if it was a biscuit, it'd be subject to VAT. Now, different countries have different policies, but generally speaking, for essential foods, you have a special rate or even no VAT, whereas something which is not an essential food, but a luxury food, that will generally attract VAT. So obviously, if it was a cake was considered to be more of an essential food. Now, this case was heard in 1991, 3 years before the most recent VAT legislation was introduced, the 1994 legislation. So this was under the old legislation. And essentially, McVitie's, who were the owner, said that this should be a cake. You need to look at you need to look at the name, Jaffa Cakes. On the other hand, the tax authority, the Inland Revenue at the time, HMRC now, they considered that it should be a biscuit and therefore should be subject to VAT. And arguments they put forward in saying that it should be a biscuit was, look at the size. The size is like a biscuit. Look at the shape. The shape is also like a biscuit. If you look at the packaging as well, it's packaged like a biscuit. If you go into a supermarket or a store and you find this on the shelf, it'll be stored with other biscuits, and therefore it should be considered a biscuit. And in the end, the court, if we were having a live presentation, I would have asked you to put your hands up to ask you whether this is a cake or a biscuit. I think many of you, based on past experience, will say this is a biscuit. The court actually concluded that it was a cake. And the key distinguishing factor why it was a cake was that in terms of, a cake or a biscuit, you need to look at what happens when they go stale. So quite often a cake actually hardens and a biscuit goes soft. So therefore, in terms of, there's a difference in moisture levels, and that was the distinguishing factor. If you look at the second one, Pringles, I mean, everyone knows about Pringles. So when you go to the supermarket, these are all over the shelves. Unlike Jaffa cakes, they're only available in some places in the Middle East. So the question here again was whether this is a potato crisp, which would be subject to VAT, or whether this was something else and it wouldn't attract VAT. So the owner, Procter & Gamble, argued that this was actually it wasn't actually a potato crisp, because they said it only has 42% potato content. It has a mouth-melting taste, and it's got a unique shape. And the High Court actually agreed with them, and they said, it's not actually a potato crisp. It's only got 42% potato content, and it's not even made from potato. And then when actually a year later, initially this High Court decision was issued in 2008, and a year later in 2009, this was appealed to the Court of Appeal, who actually concluded it was a potato crisp. So they said, "Khalas, 42% potato content is sufficient. and therefore this is a potato crisp and should attract VAT. The third one, Subway, is just a very recent case, Supreme Court case in Ireland. And I think there's no debate. Similarly to Pringles, if I had asked you to put your hands up, all of you would say this is bread. However, the Supreme Court in Ireland begged to differ, and they said because of the high sugar content, this is not bread. So, you know, bread would have attracted zero rate VAT because it was considered as an essential food, but this was regarded as a confectionery, which wasn't bread, and therefore would attract VAT. So again, it just goes to show that, you know, so there's always uncertainty, and whilst it may appear obvious, these are the kind of challenges you face. Obviously, these three examples which I've just given you all relate to food, whereas other areas also have similar complexity. If we can move on to the next slide, please. Now, what is VAT? Again, as I said from the beginning, VAT is a value-added tax imposed on the supply of goods or services. So you either need to be supplying goods or services, and it's a value-added tax. It's not a tax which is imposed on the full value. So it's just a value added at each stage. It's also a consumption tax, which is based on the final destination principle. So that means wherever you have supply of goods or services, someone there is consuming them. And the idea of VAT is that, you know, the VAT should be applicable in the final destination. So wherever the person who consumes the goods or services is in those countries, that VAT should be applicable. That's the idea. Again, as I said, unlike corporate tax, it's not a tax that the companies pay on their profits. So when your company, you're operating, you have a business, you have income, you have expenses, the difference is your profit, and you pay tax on that profit. That's a tax on income. You know, VAT is not a tax on income. It's a tax on the supply of goods or services, a tax on consumption. So, you know, it doesn't work in the same ways as corporate tax. VAT is essentially a tax which is charged at each stage of the supply chain, and the supplier accounts for the VAT and collects VAT at each stage on the value added at each stage. And generally, they're allowed to deduct the tax which they've incurred in making those supplies. And therefore, it's not a tax on profits. It's just a tax which is collected by business effectively as an agent for the tax authority. Ultimately, the idea behind VAT is that VAT should be collected from the final consumer, so it should be borne by the final consumer. But in practice, because of the contracts and you know, it may not always work like that. Although that's the idea. It's a tax on consumption, so businesses should push the tax to the final consumer, and they just collect the tax from the next person in the supply chain. VAT is also a broad-based tax with limited exceptions, especially in this region. As I was saying, you know, VAT is applicable on everything unless it's exempt or zero rated. And there's limited exceptions, you know, in the GCC model and the model which Oman's going to implement, which is more similar to the Asian models as opposed to the European models, which have lots and lots of exemptions. If we could move on to the next slide, please. So now, just to give you a particular example of how VAT works. So when you have a business, let's just say Carrefour, when Carrefour is making sales to customers and it makes sales on those customers, the VAT which the Carrefour will collect on those sales is called output VAT, which is the VAT on your sales, the VAT on your income, if you like. But Carrefour as a business will also have expenses on which it will pay VAT. So for example, on utility costs, cleaning costs, the cleaning companies will provide services. They're going to charge Carrefour VAT. Now the VAT Carrefour pays to its suppliers on procurement of goods or services is called input VAT. The idea behind VAT, and as I said, it's not supposed to be a tax on the business. They merely collect the tax on behalf of the customer, on behalf of the tax authority from the customer. So the VAT that is paid ultimately to the tax authority is the VAT the business has collected from the customers, minus the VAT that the business has paid to its suppliers. And if the difference is positive, you pay that to the tax authority. That's the VAT you're liable to pay to the tax authority. On the other hand, if you're a new business, for example, and you don't have much sales, and the VAT, or you've had a bad month and the VAT you've collected from your customers is less than the VAT that you've paid to your suppliers, and therefore you end up in a situation where the difference is negative. In that case, you're due a refund, or you're allowed to carry forward that the negative amount and offset it against future sales. Again, demonstrating that it's not a cost to the business. If you could move on to the next slide, please. Now, just to give you a more specific example of how VAT works in a supply chain. So where you have a situation where essentially a factory is selling clothes to a wholesaler, and the factory sells the clothes to the wholesaler for 10 Omani Riyals, for example, it has to charge 5% VAT. So essentially the factory charges the wholesaler 5% VAT on the 10 Omani Riyals. Now the wholesaler will sell to a retailer, and in this example, if the wholesaler sells at 20 Riyals, wholesaler will charge 5% VAT to the retailer, which works out as 1 Omani Riyal. Now the wholesaler has already, as you know, paid VAT to the factory, and is paid 0.5 Omani Riyal to the factory. So the wholesaler is essentially paying VAT on the value added at this wholesale stage, which is the VAT collected here of 1 Omani Riyal minus the 0.5 Omani Riyal, which has been paid to the tax authority. So now and then essentially the retailer will supply the services to the consumer, and the retailer will collect VAT from the consumer, which is, if it's been sold at 40 Omani Riyals, the amount of VAT is 2. And again, the retailer has already paid VAT to the wholesaler. So the output tax is 2 minus input tax, and it has to pay 1 to the Omani tax authority. Now the total amount collected by the Omani tax authority is 2 Omani Riyal, 0.5 Riyal from the factory, 0.5 Riyal from the wholesaler, and 1 Riyal from the retailer. So this is collected at different stages of the supply chain on the value added at each stage, and the amount paid by the final consumer is actually 2, which is the same, but it's collected at different stages. It's a very efficient tax where the government gets revenue on a regular basis. If you move on to the next slide, please. Now, in terms of understanding VAT, there's generally 4 types of supplies which are very important. And generally, there's a distinction between taxable supplies and non-taxable supplies. Now, there's 2 types of taxable supplies. Taxable supplies are supplies which are effectively subject to VAT. Now, they could be subject to VAT at the standard rate, which is 5%. So the standard rate is 5%. So if you're subject to VAT at the 5% rate, that's called the standard rate. On the other hand, you could be subject to VAT at the 0 rate as well, but you're still subject to VAT. Now I'll come on to the distinction and why this is important. So essentially, if you're making standard rated supplies, on the supplies you're making to your customers, you have to charge VAT at the standard rate, which is 5%. But on the other hand, because you're making a taxable supply, you're allowed to deduct the VAT you've paid to your suppliers and the VAT you've incurred on your costs. So essentially, you pay the difference to the tax authority in this case. In the case of a 0 rated supply, as I said, you charge VAT at the 0 rate, but because it's a taxable supply, you can deduct the VAT you've incurred on your expenses. So the difference is that you've collected no VAT, but you can deduct VAT. So therefore, you end up in a repayment position. So this is a difference between standard rated supplies and 0 rated supplies. You charge VAT in both cases, but the difference being in one case, you actually collect VAT, in the other one, you don't. And you end up in a refund position in 0 rated situation because you're actually making a taxable supply. Now, the difference between a 0 rated supply and exempt supply is in both cases, you don't charge any VAT, but in the case where supply is exempt, you're not allowed to recover or deduct the VAT you've incurred on your costs to your suppliers. So therefore, if you're making an exempt supply, you don't charge your customers VAT, but it could end up being a cost to you because you're not allowed to deduct the VAT or recover the VAT you've paid to your supplies. So therefore, it's a cost. Now, in the case of outside scope supply, again, no VAT is applicable on the actual supply. and import VAT may or may not be deductible depending on the situation. It's very important to understand the difference in these types of supplies because this is the cornerstone of the application of VAT. If you could move on to the next slide, please. So generally speaking, whenever you have a tax law, you have to have a framework, and that's what's happening in Oman. So as I was saying, Oman's already published the VAT law. The regulations will be published sometime in 2021. And Oman has implemented in its VAT legislation, or will implement in its VAT regulations, the principles which is agreed to in the GCC VAT agreement. It hasn't incorporated the VAT agreement as part of its local law in the same way Saudi has. So Oman's taken a very similar approach to the UAE, where it's going to have separate legislation, its own legislation, which will determine the application of VAT. Now, the typical things you'd have in the VAT legislation, what's the scope of VAT, on what is VAT applicable, at what rate is it applicable, when will the VAT legislation be enforced, where is the place of supply? And this is critically important because, as I mentioned, the VAT applies where the consumption takes place. So the idea is VAT should apply only on consumption, where the consumption happens in Oman. Time of supply is important because that's what dictates when you pay the VAT, the period in which you pay VAT. Of course, registration for VAT is important. When should you register? Who should register? The types of supplies which I've just talked you through. Who's liable to pay the VAT, account for VAT? Obviously, the framework in relation to compliance. When should you file a return? Transitional provisions, obviously VAT coming new, you having old contracts. How do you deal with that? When should VAT apply if you have an old contract, your new supplies? In terms of special schemes as well for tourists, for foreign businesses, for governments, obviously dealing with objections and appeals and what happens in the case that you don't comply. So penalties, avoidance, evasion. If you could move on to the next slide, please. Now, as I mentioned, the GCC agreement contained some things which all GCC countries had to follow. There was other things which GCC countries had more discretion. And that I've specified a few things here where there was discretion in terms of, how they should go about it. VAT grouping, for example, the invoicing requirements, should they be in the Arabic language? Should they be in English? Could you have both, for example, when it comes into force, the objection appeal system, transitional provisions. So just to give you a flavor of the kind of things that Oman had discretion on, where, in terms of legislating for VAT. Could we have the next slide, please? Now, the scope of Oman VAT essentially applies to three things. So if you, as I said, if you supply goods or services, or if you're not a supplier of goods or services, if you receive goods or services from someone who's non-resident in Oman, and in cases where, for example, the reverse charge mechanism is applicable. If you import goods as well from outside Oman, that will also attract VAT as well. So essentially, as I said, you need a taxable supply. It needs to be goods or services made by a taxable person. Now, taxable person is someone who's registered or should register for VAT. And the supply needs to be in Oman. If the supply isn't in Oman, then there'll be no VAT. So there'll be rules related to place of supply, which are important. The other thing is that you need consideration as well, which is anything you receive in return for supply. So therefore, anything you supply in return for some consideration is a supply for VAT purposes and subject to VAT. Even in cases where you don't have consideration, there may be a deemed supply. So there's generally rules for that as well. If we could move on to the next slide, please. Now, in terms of who should account for VAT, generally speaking, it's a supplier of goods or services who should account for VAT, but there are exceptions as well. So in terms of the exceptions, where goods and services are being imported, the importer should account for VAT in those cases. There's certain instances where, for example, the supplier is not registered for VAT and they're non-resident supplier, but the customer receives goods or services from the supplier who's abroad. Now, in these cases, Oman will have the reverse charge mechanism, which is essentially is treated as if the recipient of the services or goods makes a supply to themselves. and therefore they have to self-account for VAT, but they also allowed a deduction for that as well. It's called the reverse charge mechanism because generally the supplier is required to account for VAT, whereas in this case, the customer is required to account for VAT. And otherwise, you'd end up requiring all the suppliers to register for VAT. So this kind of like acknowledges that you already have someone registered for VAT, although they're the customer, so they have to account for VAT on the supply that they've received rather than the non-resident supplier. In some cases, the foreign supplier does have to register for VAT. If they have a place of residence in the UAE, in Oman, and they exceed the mandatory registration threshold, which we'll come on to. In other cases, the foreign supplier has to register an account for VAT, even if they don't have a place of residence, if they essentially supply goods or services in Oman and they're subject to VAT in Oman, but no one else in Oman, the customer, is, for example, accounting for VAT on such supplies. If you can move on to the next slide, please. Now, in terms of the rate, the rate's been set by the GCC agreement at 5%, and Oman will respect that because it signed up to the GCC agreement. You've probably seen in recent months, Saudi increased the rate from 5% to 15%. So they tripled the rate from July. Technically speaking, the rate should have been increased under the framework of the GCC, and all the GCC countries had to agree. But of course, Saudi unilaterally increased the rate in their country. But Oman will not be having a rate higher than 5%, so they'll be sticking to the 5% rate, which has been confirmed. In terms of mandatory registration, so if you're making supplies above a certain above the mandatory registration threshold, you'll be required to register for VAT. And essentially, at the moment, the Oman VAT law doesn't contain a mandatory registration threshold, but the GCC VAT agreement states the mandatory registration threshold by reference to Saudi riyals, which is 375,000 Saudi riyals, which equates to roughly $100,000 and 38,500 Omani riyals. So that will be the mandatory registration threshold. There's also a voluntary registration threshold as well. So voluntary registration threshold is where, as the word suggests, that you're not required to register, but you may register. Why would you register? If you're not registered, the VAT that you've paid on your costs to your supplies, you cannot recover. So some businesses may register in order to recover the VAT, and at the same time, maybe to give their clients a standing, because a lot of companies will know that you're a small business if, for example, you're not registered for VAT. So some businesses, for that reason, take the decision to register. But there's a threshold for that. It's not you're not allowed to register in any circumstance. So the threshold is equivalent to Saudi riyals 187,500. And again, this threshold is not in the Omani VAT law yet, but it's roughly going to equate to 19,250 Omani riyals. So in order for you to register even on a voluntary basis, you need to make supplies or have expenses which exceed this amount. In terms of non-resident, there'll be no threshold for them. So if a non-resident is making supplies in Oman, regardless of the threshold, they're going to have to register, whether directly or through a representative. In terms of meeting these thresholds, what you essentially have to look at is the supplies that you're making in the current month and the previous 11 months as well. And also in the current month and the next 11 months. So this is essentially the reference point in determining whether you exceed the mandatory registration threshold or the voluntary registration threshold. As I said, in terms of registering on a voluntary basis, even if you're a new business, for example, you may not meet that limit, but they'll also look at your expenses as well. So they allow you to register if your expenses exceed, for example, 19,250 Omani riyals. A lot of people, are probably expecting, a delay and, a grace period. There's obviously nothing in the law. As far as the law is concerned, VAT is going to be introduced 6 months after the publication of the law in the Oman Gazette, which was on the 18th of October. So that's a hard date. In terms of whether Oman takes an approach like the UAE, where everyone actually registers for VAT from day one, or they have some sort of grace period in the same way Saudi had. Saudi allowed small businesses which had turnover of less than 1 million, they gave them an extra year. Bahrain had a phased implementation approach where, based on the turnover, businesses were required to register. So businesses with a very high turnover registered on the 1st of January. Other businesses followed on the 1st of July. And by the 1st of January the following year, which was the beginning of this year, all businesses were required to register if they were required to register. If you're making supplies which are only zero rated, you may ask to be accepted from the requirement to register. So that's something that Oman will follow as well. Now, the key compliance obligations, of course, filing and payment is important as well. And in Oman, what we do know from the VAT law, that filing and payment will happen within 30 days of the end of the tax period. What we don't know is what tax periods there will be. Generally speaking, it could vary from country to country, and Oman hasn't specified as yet. But generally, I think it's either going to be quarterly or monthly. For bigger businesses, it's going to be monthly. For smaller businesses, perhaps quarterly. Maybe the tax authority will have discretion. Maybe they'll set some criteria based on revenue, or maybe they'll have internal criteria. But this is the general expectation. The time of supply is also important. As I said, if you're supplying goods or services, you need to know when do you account for VAT and pay VAT. And generally speaking, the time of supply, it's not just the supply of goods or services that you make. It could also be triggered, for example, if you're issuing invoices. If you're issuing invoices, that may become the date of supply, even though you haven't even provided the service. And in some cases, even if you haven't issued the invoice, you haven't supplied the goods or services, but if you've received the consideration, then you have to account for VAT in that period. There'll be requirements to issue tax invoices. So this is going to be something very new in Oman. Of course, you all are already issuing invoices, but the VAT regulations will probably introduce a very prescriptive format in terms of issuing invoices. So you're going to need to make changes to your policies and processes to make sure that the invoicing format is updated. For small supplies, for example, if you go to a restaurant, you're probably going to have simplified invoices where the invoices are issued to individual customers, or the amounts of the invoices are very low. The format language remains to be seen, and this will come in the regulations. There'll also be a requirement to keep records as well. For generally it's 10 years, and in the case of capital assets, the records are required to be kept for 15 years. The penalties we've seen are very, very high, and Oman will of course have penalties. A lot of detail is going to follow in the regulations, but in the UAE, for example, the penalties were as high as 300% and 500% for evasion. In Saudi Arabia, in Bahrain, the penalties are 25% of the tax amount. So some detail is already there, although a lot of the details and penalties will follow in the regulations. But Oman will also, there's a possibility of a financial penalty plus also imprisonment for certain offenses, particularly if you're doing something deliberately or you're involved in evasion. And so therefore you have to be careful and make sure you get things right the first time. There's also going to be special schemes as well. The question is whether they'll be introduced on day one or whether they'll be brought in later on. So for example, VAT refunds for tourists, for foreign businesses, for foreign governments as well. Oman's also going to have a concept of VAT grouping. Normally, if two separate companies, even though they're part of the same group, if they make a supply to each other, it's subject to VAT in the normal way. But if you group the two companies for VAT purposes, then it won't be considered a supply. The detail of that is going to follow in the regulations, but there'll probably be some requirements with respect to control. There's also going to be some transitional provisions because many people will think, okay, VAT is coming in, let's issue the invoices now, let's receive the payments now, and we don't have to pay VAT. If the supply is going to be made after the VAT law comes in and is effective, then it'll still be subject to VAT. So that's something you have to be conscious of. For contracts that are silent for VAT, the price will be deemed to be inclusive of VAT. So therefore, the onus on the supplier will be on the supplier to account and pay the VAT. There may be some exceptions that come out in the regulations. For example, in certain cases, allowing the supply to be treated as exclusive of VAT, which was the case in the UAE, or allowing the supply to be zero rated for a certain period, and subject to certain conditions, as was the case in Saudi Arabia. Obviously, as I said at the outset, that if you have excess input VAT over output VAT, then you'd be allowed to essentially get a refund, or you'd be allowed to carry forward. If you've collected VAT from someone and you don't receive the money, then there'll be some conditions for relief available, bad debt relief. In the UAE, for example, the period was set at 6 months. In Saudi Arabia and Bahrain is 12 months. And in the UAE, the conditions were essentially you write off in your accounts, whereas in Saudi and Bahrain, you have to go one step further and initiate steps to collect the amounts. So for example, court proceedings. If you move to the next slide, please. I'm just going to go through this quickly. So as I said, it's very important to know where the place of supply is for VAT purposes. Only if the place of supply is in Oman will VAT be applicable. And there's different rules for goods and services. Generally for goods, the rule is that if the goods are being supplied without transportation, the place of supply is the location of the goods when they're placed at the customer's disposal. If they come with transportation, then effectively it's whenever the transportation or dispatch commenced. If you move on to the next slide. And there are also special rules as well for the place of supply. So this is a general rule for goods. However, for services, the general rule is that if the supplier is resident in Oman and the customer is not a taxable person, the general rule is that essentially where the taxable supplier is. Otherwise, the place of supply for services is where the customer's place of residence is. The special rules are applicable, for different types of services. So, for example, for real estate, the place of supply, related services, the place of supply is always where the real estate is located. For telecommunication and electronic services, the place of supply is where the services are used and enjoyed. And for generally other types of services like restaurant, hotel, cultural, artistic, or sporting services, the place of supply for VAT purposes is where the services are performed. If you move on to the next slide, please. There'll also be some provisions for transfer of going concern. So essentially, if you're transferring a business, it shouldn't attract VAT, but there'll be conditions attached to that as well. So that remains to be seen. Hopefully, we'll have more details in the regulations. But the idea is if you're transferring the business as a going concern, it shouldn't attract VAT. I've already talked through the transition provisions, and tax identification number, has to be included in the return notification invoice. So this is a big compliance requirement, which wasn't there before. If we move on to the next slide, please. I'll just quickly whiz through these. As I said, there's going to be specific rules in relation to powers of tax authority and appeals. And there's also a penalty regime there, and there's financial penalties. There's also imprisonment sentences as well, depending on the nature of offense. So if we move on to the next slide, because I think we're sort of running on out of time, and there's still quite a few things to cover. Under the GCC agreement, there was scope for Oman to, it had some discretion in relation to certain supplies, and it also had to do certain things in the case of other supplies. So the GCC agreement didn't really force Oman to decide the VAT treatment on everything. There were certain things Oman was required to do, and there were certain things Oman had discretion to do. If we move on to the next slide to see what Oman is actually doing. So Oman has decided to zero rate food items, which was in addition to the GCC VAT agreement. And also Oman decided to zero rate medicine and medical equipment, investment grade precious metals, international transportation of goods and passengers, and also exports of goods and services as well, more generally. This was also in line with the GCC agreement. Oman, interestingly, exempted, financial services, bare land, which was similar to the UAE. But in addition to that, Oman is also exempting healthcare, education services, and also resale of residential real estate and renting of real estate for residential purposes as well as local passenger transportation and some imports. And everything else which is not zero rated or exempt will be subject to VAT at the standard rate. So that's everything else which doesn't fall into these categories. For example, water and energy. If you move on to the next slide, please. Now, a lot of people think that VAT is just a tax, and it just, you just have to pay the tax and that's it. You have, it's a tax, you have you have to complete a return, you have to pay it. There's actually a lot of work that you have to do beforehand, and it does impact the whole organization, your suppliers, your customers, everyone. So it requires everyone to really get together and understand, how you're impacted. So just to touch on a few things, legal is a very important one, because of course you've got existing contracts which maybe didn't have VAT clauses, and now you need to think about what you need to do with those contracts because they previously didn't have VAT, and now you need to amend those contracts. For new contracts, you obviously need to include clauses. You need to check the payment terms as well, because if you have to account for VAT and you're not receiving payment for a long time, it could end up being a cash flow issue for you. As well as understanding the cash flow position as well. If you have a special tax department, you're going to be concerned with making sure you register, comply, understand the tax treatment of the different items, understanding what's subject to VAT or not, what your obligations are, and just making sure you comply. There's certain transactions on the HR side, for example, giving something for free to an employee may trigger VAT. So nothing within the organization is exempt. Even transactions internally, which you wouldn't even think about, could attract VAT as well. Providing like a computer to an employee, and all these things has VAT implications. Staff entertainment, VAT recovery on that may be blocked. So it's something you have to watch out for. Finance, of course, from a cash flow perspective, they need to look at, in terms of, paying VAT, you need to check the invoices, because if you don't have a valid tax invoice from your supplier, you can't recover the VAT. So therefore, payables will need to, before paying, they need to check that the invoice meets these requirements. You also need to keep on top of bad debts as well to make sure that you recover the VAT. The IT systems, at the moment, maybe your IT systems aren't capable for accounting for VAT. So therefore, you have to look at, what's the current status of your IT systems? Are they VAT savvy? Do they need to be updated? Do they need to be upgraded? What changes are required? They obviously need to be ready to account for VAT and produce reports for VAT returns and make sure your invoicing is in line with the VAT requirements. Also, on the sales and marketing side, of course, you need to look at the impact of VAT on your pricing, and you need to have these discussions with your clients. On the procurement side as well, you need to have discussions with your suppliers. All around you with your customers and your suppliers, you need to help them understand VAT is coming in. You're going to have some obligations, you have some expectations, you're going to increase the price. All of this communication is necessary before VAT comes in, and it's a lot of work, quite frankly, which is required to be done. If you move on to the next slide, please. Now, some of the lessons which were learned from UAE, KSA, and Bahrain, I think the major one is, the late implementation of VAT. Many people, in all these countries thought that, okay, look, we're here in the Middle East, and we've seen countless situations where they were going to introduce laws, and they set dates for laws, and these laws were never implemented, they were never introduced, and therefore we have time, we have lots of time. And they didn't do anything. And then literally a month before VAT was introduced, they actually got their act together, and by then it was too late. Typically speaking, VAT, in terms of an organization to prepare properly for VAT, it takes 3 to 6 months, to assess the impact it's had on your organization, what actions you need to take in order to be compliant on day one. It doesn't happen overnight. It takes time, it involves a process. The whole organization needs to be involved in this process. So I think it's critical that businesses are proactive and don't wait till the final moments, because this is very much a process that takes months rather than days. So the quicker you get your act together and do all the work to make sure that you're compliant, the better it is. Otherwise, you risk significant penalties. And in many cases, these penalties are so significant that they could put you out of business. So therefore, it's very, very serious, and it needs action immediately. If we move on to the next slide, please. As I said again at the outset, that when the VAT law comes in, there will be some uncertainty, and essentially you have to navigate through this uncertainty and make sure you try to sort of come to the best position possible with a minimum amount of risk. Because whenever there's uncertainty and you get something wrong, there's obviously you're going to have an error in the future, which is going to result in penalties. So you need to make sure that your employees are trained and you fully understand the consequences. You identify areas where there's risk, and you highlight this to management just to make sure that everyone's on board and the decisions are taken at the top level. Next one, please. There's a lot of specialized industries like the banking, financial services industry, insurance industry, and there's many industries. Over time, the tax authority will issue guidance, and they provide, maybe introduce special schemes which specific industries can take advantage of. But this will happen in due course, and it will take some time as the tax authority develops and refines its policies on VAT. If you move on to the next slide, please. Another one is a lot of businesses, they thought, as I said, it was just a case of turning on the switch and paying the VAT and filing returns, but there was lots of work required, and they perhaps didn't train their people well enough, and so the people couldn't identify the VAT implications, and therefore they've gone into situations where there's errors and they've done things which are wrong, which they could have addressed had they given the relevant training. So obviously lack of training means, high risk of non-compliance. If you move on to the next slide, please. Again, in Oman, it doesn't look like there's going to be a consultation period, which was there in Saudi for 1 month. So I don't know, it may be worth you looking at how your industries are affected, and maybe whether you want to raise any points to the government or give them any feedback. It'll of course be, once VAT is introduced, it'll be important to register on time to make sure you don't have any penalties. And even before that, as I said, being ready is a critical one. Understanding the role of a tax authority is also important. A lot of people, in UAE, in Bahrain, in Saudi, make the mistake in thinking that, the tax authority has a helpline. We're going to get all of our answers. It doesn't work that way. The tax authority is there to collect the tax and manage the process. They're not there to advise you. They don't have the resources for that. No tax authority does. So of course they'll issue some guidance, but they're not going to be able to respond to everyone and everything. And frankly, it's not their job to advise, although it's their job to give guidance, which will happen over time. But you can't afford to wait for that length of time, before you get things right, because there could be penalties. You also need to budget for compliance. There'll be an upfront cost in terms of your technology, in terms of undertaking the impact assessment, how you impacted, and there'll be ongoing cost as well going forward related to compliance, filing returns, paying your VAT, and managing that. As I said, if there's uncertainty, you need to manage the risk, and you need to make sure, because ultimately, maybe it's the legal department, maybe it's the finance department, maybe you have a specialized tax department. There will be someone at the organization responsible and held accountable for making sure you do the right thing. And if there's any penalties, the consequence will fall on them. They'll be responsible. So just making sure you have a risk management policy and framework in place, and you follow that religiously, and you have the relevant sign-offs at the relevant levels. If you move on to the next slide, please. No. So now, in terms of what you guys should do now to get ready for VAT, and to be in a position where you could comply on day one, at the moment, the key thing is to make sure you have a project plan. So you need to have a budget for implementation. As I said, maybe you're going to have to require to bring in a consultant to assess the VAT impact. Maybe you need to give some training to your staff. Maybe you'll choose to hire resources internally to help you comply with your VAT, depending on the complexity involved. Maybe you need to upgrade your IT system. This all involves cost, so budgeting for that is very, very important. Having a steering committee in place, a steering committee should perhaps involve someone from a different function, maybe someone from legal, someone from finance, someone from marketing, someone else from procurement. So you have representation, someone from IT, so everyone can join heads and try to sort of contribute in a different way, and discuss how the organization will be impacted, and therefore join heads and take decisions on behalf of their relevant function. You also need to raise awareness within the organization, so education and training of employees, both in terms of how it impacts them personally, but also in terms of whether anything is required on the organization's part. Because maybe, for example, HR have to account for VAT on something and they don't know about it. So that training is very, very important, just to raise awareness and make sure that you get things right. A VAT impact assessment is important as well. And ultimately, you need to understand, how the VAT law and the introduction of VAT impacts you as an organization, what your obligations will be, on what you need to pay VAT, on what you're allowed a deduction, what are your other obligations. All of these things you need to know. And this is normally done through an impact assessment, which will look at, what your position is now, what you need to do to become VAT compliant, what your key obligations will be, what the VAT treatment of your supplies will be as a business, uncertainty, whether you're going to take a position, whether you need management's approval for that. Again, going back to the risk management point that I was making. Cash flow also and working capital requirements, very, very important. So as a business, you account for VAT on an accruals basis. You issue the invoice, you have to pay the VAT. You may not have received the money from your customer. At the same time, right now, you don't have to pay any VAT to your suppliers, but going forward, you are. So lots of cash going out. You need to make sure that you're ready and able to support your business, and therefore your working capital requirements are up to date. Again, just to hone on the systems and IT, you need to analyze your existing systems and consider your current capability and how you could upgrade that in order to be compliant and produce the necessary tax reporting. From a pricing perspective, I mean, as a business, when VAT comes in, you'll be required as a supplier to account for VAT. Now, what are you going to do? Are you going to absorb the cost? Are you going to pass it on to your customer? So these are strategic decisions that you need to take. Maybe you need to also look at what your competitors are doing, because you don't want to pass on the cost to your customers when your competitors aren't doing that. Otherwise, you'll no longer be competitive. Contracts, again, this one's for legal. Reviewing existing contracts. How are you impacted for VAT? Do you need to amend these contracts? Do you need to send notice to your suppliers? Do you need to send notice to your customers as well? How are certain supplies impacted? Where, for example, it's an old contract which is continuing after the VAT law comes in. Should you account for VAT? Should you not? On what? So all of this is relevant. Having a VAT clause in place for all new contracts. Processes as well. So your accounts payable processes, making sure you have relevant documentation before paying the invoices, keeping records, keeping the supplier invoices, making sure the invoices are in certain format. All this is very important. Communicating with your customers and suppliers as well. I've mentioned that before as well, very important. Just to keep that business relationship going, and also remind them about their upcoming obligations and your obligations as well. So just so it doesn't come as a surprise. And ultimately, it's all about complying. So once you've got the house in order, and as you can see, it's not an overnight job to, go from 1 to 10. It doesn't happen in one day. It doesn't happen in a few days. It is a process, and it will take time, probably months. So the sooner that you start, the better it is. I think that what we've seen in UAE, Bahrain, and Saudi, businesses that waited to the end, they suffered, and they're obviously making a lot of errors, and they're being subjected to very high penalties. If you move on to the next slide, please. So these are the phases we're generally assisting clients in. So phase 1's about preparation and review. And I've just mentioned some of these points already. So just having VAT awareness workshops, reviewing your as-is situation, what you need to do to become compliant, communicating internally and externally, making sure everything's in place. Phase 2, which is impact assessment, involves reviewing the legislation. And even you don't need to wait for the regulations to come in, because roughly we know what it's going to look like. And later on when the regulations come in, they may give us that additional 3-4%, but most of that we probably know already, although it's not there codified. We don't need to wait for it, because that's asking for trouble. You'll end up in a situation where you make a lot of errors. Transaction mapping as well, which you need to do to work out, how you're going to treat these transactions in your system. And that follows on to the implementation phase as well, which also looks at transition planning, reviewing contracts, and having the relevant documentation in place, testing, and phase 4 is post-implementation. So after VAT is introduced, registering, filing returns, just making sure that you're compliant on a regular basis. Next slide, please. Yeah, I mean, Al-Tamimi, we're a regional tax practice, and we cover every area of tax across the whole GCC. So in addition to your VAT requirements, we could assist you in any area of tax. So yeah, feel free to reach out to us if you have any questions, if you require any assistance. If you move on to the next slide, please. So yeah, I think that, that sort of covers the introduction in terms of VAT in Oman, and I could see in the Q&A box that there's been quite a few questions. There's a mention here, there's a few questions. The first question is, what about the impact of the VAT on the VAT taxation system prior in Oman, the COVID impact? So obviously we're going through COVID now. Now, obviously, if Oman wants to take into account this impact, they should have done perhaps already. Obviously, they're going ahead in April. COVID is already going on, so I don't really expect any concessions right now, because Oman hasn't even introduced the VAT law. So the first thing they would have thought about is that, in the current environment, when should we bring VAT? And obviously, knowing the whole situation, they've decided that April next year is the right time. So I don't expect any delays. Obviously, that's already there in the VAT law now, which has been gazetted. So this is law, and this is what's going to happen.
Indeed, yeah. Just to add, Shiraz, on that point, having considered the law, of course, the implementing regulations haven't been issued, but there is no exemptions in relation to events like COVID-19, unless the tax authority, of course, unilaterally decided on that.
Correct. And in terms of what other countries did, so in Saudi and UAE, generally for VAT, they just postponed for a few months. They postponed the VAT returns and also allowed you to pay a little bit later on. It was just for a few periods. So nothing much is expected. So everything's on track for the go live date on the 16th of April next year. There's a question here, what are the rules with regard to reduced VAT rates, and what types of goods and services can benefit from these rates? As I mentioned, Oman is essentially implementing the principles which were agreed in the GCC VAT agreement, and the GCC VAT model, it doesn't have multiple rates. Like in Europe, if you go to the UK, you'll have like the standard rate, which is 20%. You'll have a low rate of 5%. And you have different rates within the country. In the GCC, the rate's fixed at 5%. Obviously, Saudi is an exception to that right now. The only other rate which is there is a zero rate. Now, the zero rate is there, and I've already discussed, I think, in one of the earlier slides, some of the supplies which will be subject to zero rate, and most of these come from the GCC agreement. So the supply of, for example, precious metals, the export of goods and services, the supply of passenger and goods transportation, international transportation, all of these essentially come from the GCC VAT agreement. And there's other things that weren't there in the GCC agreement that Oman had the option for, which is actually gone ahead with, and it's zero rated, and that was food items. But it remains to be seen which food items and under what conditions they'll be zero rated. And as you saw in the earlier slides, food is subject to a lot of litigation, which is why countries like Saudi and UAE chose to actually tax food, even essential food. because the rate was quite low, 5%, the lowest rate in the world. And there was lots of litigation and uncertainty on the food items. And to avoid all of that, they just decided from a policy point of view that it was better just to tax everything.
Yeah. Shiraz, one question here. With the zero rated and exempted under the agreement in relation to each member state, is there any, like after certain years or at any stage, they would have to apply the VAT, or they can still continue exempting such goods or services?
No, that's a good question. I mean, obviously the zero rate and exempt, and both of them are different. What both have in common is that you don't charge any VAT to your customers. But exemption, whilst for other taxes is a good thing, for VAT is a bad thing because it may end up being a cost for you. Now, in terms of your question, if you're zero rated, you're exempt, you'll continue, provided you carry on making those supplies, you'll continue to be zero rated or exempt unless there's a change in law, which obviously will happen if there's a change in policy. So in the future, they can introduce more zero rated items or perhaps reduce, and this will require a change in law. So as far as the situation is concerned now, once the VAT laws imposed, after that, if you meet the requirements, then you have to zero rate and or exempt accordingly. And it's not subject to any time limit.
Oh, thanks.
There's a question here that which businesses are required to register for VAT, and when a business is required to file the VAT returns. As I said, at the moment, there'll be further detail in the regulations, but businesses which are effectively required to register for VAT are those businesses which make taxable supplies as opposed to exempt supplies. And the value of the taxable supplies exceeds the mandatory registration threshold by the end of the month, the previous 11 months, and the next 11 months as well. So if you exceed the mandatory registration threshold during these periods, then you have to register for VAT and account for VAT. In terms of when you're required to file VAT returns, like I said, that may depend on the business, and there'll be more details in the regulations. You're likely to be either a monthly taxpayer or quarterly taxpayer. So if you're a monthly taxpayer, you'll have a tax period every month, and you have to pay the VAT and file the VAT return within 30 days of the end of that period. If you're a quarterly taxpayer, then you'll have a 3-month tax period. So your first filing and payment will be required 3 months after, 30 days after the 3 months, which will be after 4 months from the period when the period starts. It's possible that your first period may be different, and then subsequently the tax authority assigns you a periodic period, which is 3 months, 2 months. So it's very much the discretion of the tax authority, and it may also depend on the rules, depending on how codified they are and how restricted they are. There's another question here. With the VAT looming ahead, how can businesses work towards their advantage? I don't think necessarily that it'll be an advantage for businesses. Obviously, it shouldn't be a cost to them if they do things the right way. So you really need to make sure that you prepare properly. But VAT is essentially you as a business collecting the VAT on behalf of the government from your customers, and obviously paying the VAT to your suppliers. So you need to make sure that you comply and you essentially do the right thing. So this is what VAT is about, rather than creating an advantage for your business. Obviously, there may be some advantages where some business is absorbing it as opposed to charging their customers, and that may make you cheaper, for example, but then it will also increase your cost. So these are business decisions that you have to take. There's another question here. How can companies ensure that the newly developed tax strategies are compliant with the VAT law? I think I've already discussed, 10 points and different ways, because you really need to make sure that you're prepared, which involves, doing your homework internally as an organization, getting ready for the VAT, making sure you understand your VAT obligations, making sure you understand the VAT treatment of all the transactions, making sure your people are trained, being ready from a cash flow point of view, because you may end up in a situation where you don't have enough cash because of the VAT. So how do you manage that? All this work you need to do now. So, your policies, whatever they are, need to be updated to take into account VAT, because at the moment there's no VAT. So your policies are probably likely to be out of date. So there's another question here. How will newly VAT impact GDP growth and inflation, as well as investment behavior in Oman? I think that's a good question. I mean, VAT is obviously a tax, it's an indirect tax. And one of the reasons why it's popular is that it doesn't really affect investment into the country, because as a business, it's not a cost to you in most cases. So you just have to collect the tax, and there's a burden and cost involved in complying. But it's not the same as a corporate tax, for example, which is actually a cost to you, and you have to pay that on your profits. Now, in terms of inflation, and customer reaction, there may be sort of upfront, one-off sort of rise in prices, but people will generally get used to it quite quickly, and then there'll be a correction, and things will generally normalize. I think on the plus side, 5% is not very high. It's the lowest rate of VAT in the world. There's lots of obviously beneficial treatments, zero-rated items. Some things are exempt. So therefore, it shouldn't impact you in every sense, but of course, it's something to think about as a business. There's another question here. What are the potential factors that determine the success of implementation of VAT? I've already discussed them as far as the organization is concerned. In terms of implementation of VAT, there's obviously a role the tax authority also has to play in terms of training, having awareness sessions, making sure their systems are in place, that their employees are trained, and everything is generally, because there's readiness and impact assessment on both sides, tax authority and also the taxpayer. So to make it a success, I think, the tax authorities have to be ready, and I think Oman will be. They've had quite some time, and this is one of the reasons why they didn't already push the go button, because it was due to lack of preparedness. Whereas now, obviously, they've had more time, so you'd expect them to be in better shape, and also learn from the lessons in UAE, Bahrain, and Saudi. Which sectors will be mostly affected by introduction of newly VAT systems in Oman? I think all sectors are affected, and they really need to understand. I mean, from a price point of view, those sectors which are exempt, obviously it's going to end up being a cost for them. So they need to think about whether they want to increase their prices, because otherwise the VAT will be a cost to them. There's a question here. Will export of services from Oman to other GCC countries still be considered zero rated? Will it still be considered zero rated? Yeah, generally in VAT, as I said, it's based on the consumption, it's based on the final destination principle. And the whole thing with exports is when you're exporting, you're supplying outside the country. So therefore, consumption is the customer who's receiving or going to benefit from these services or goods, or use these goods or services, they're going to be outside. So generally, it should be subject to zero rate. But where you have supplies within the GCC, if you make supplies to another GCC country, that should be outside scope. The problem is because there's different rules in different countries. So at the moment, the GCC hasn't really implemented electronic services systems. And in Saudi, the VAT rule is that even if a country's implemented VAT, for VAT purposes, it'll be considered as a non-implementing state and therefore non-GCC state until the electronic services systems are ready. In the UAE, they have some rules that they'll treat other GCC countries as a non-implementing state, even if they've introduced VAT, if they don't comply with the GCC VAT agreement, or they consider the UAE a non-implementing state. So at the moment, although Saudi, Bahrain, and UAE have introduced VAT, for VAT purposes, they're treating each other as a non-implementing state. So therefore, like any third country. So normally, supplies made between GCC countries would be outside scope, but at the moment they've been treated as an export if they meet the criteria. Now in Oman, it remains to be seen what the criteria is going to be. I mean, sometimes it can be fairly broad. In other cases, it can be fairly restrictive. For example, you know, if even if you're providing services or goods to someone outside, if someone in Oman is benefiting or using or enjoying directly or indirectly, maybe the zero rate won't apply. So there are these challenges. There's some other questions here.
Yeah, thinking broadly here, Firaz, on this question about movement of goods between GCC states generally, of course, with the aim of creation of a unified market. Not sure if this would create any obstacles when, of course, moving goods between GCC countries, given that, of course, some countries may apply different rate, like Saudi Arabia, which is 15%, and Oman, 5%. Just thinking broadly on the impacts on that in the future, if this occurs.
Sure. I mean, if you're exporting goods from let's say from Oman to Saudi Arabia at the moment, you know, my expectation is that Oman will likely treat Saudi Arabia as a non-implementing state. So provided that you meet the criteria of export of goods and you have all the relevant documentation, it should be treated as zero rate from the perspective of Oman. However, from the Saudi perspective, you know, you're receiving goods, you'll be importing. Now that the rate is 15%, from a Saudi perspective, whoever is importing will be required to pay VAT. The importer of goods will be required to pay that VAT at 15%.
Okay, understood. And vice versa for Oman when goods are exported from Saudi Arabia.
Yes, from Oman's perspective, it should be zero rated. If it's an export, and they generally have a lot of criteria associated with it. You know, and even the same principle applies to services, but somehow there's more restrictions. So if the services relate to immovable or movable assets in Oman, or otherwise maybe someone else is benefiting because maybe on paper you've contracted with someone else who's going to receive the services in another country. However, maybe the real recipient of the services is sitting in Oman. You know, so the rules will need to be seen in more detail in that regard. But potentially it may still apply the zero rate, or maybe they'll exclude this from the supply of zero rate.
This which leads to the concerns of consumers generally over the GCC that the prices of the services and the products may go higher, even higher than 5%. So if the traders decide to just price it high.
Yeah, I mean that did happen in some cases. It shouldn't do really. I mean, because essentially all VAT is collecting a tax from customers, so the price shouldn't go more than 5%. If some people they want to increase their price, and that will be subject to the price control mechanisms and laws and regulations already in place. Obviously, VAT shouldn't be a part of that. But you know, if they otherwise they're increasing the price, then they'll have to monitor whether they're compliant, and also they have to look at the competition as well. So essentially, if you're increasing your price, then you're going to be less competitive than other people.
Okay.
Is there any other questions that you had, Ahmed? Or
I think that's fine. Just talking about price control mechanism. I understand it might be the case in some European jurisdictions, which may not be the case in some GCC jurisdictions. They have competition laws, of course, but if just clarification about this price control mechanism and if you have come across it in the GCC countries.
I haven't had too much experience, but you know, in the retail sector, for example, they have, you know, certain, they may have some certain laws, and you know, maybe for example, even the central bank, it may regulate, you know, what banks charge to their customers, you know, for certain fees and how much they could increase these fees by. So there are all these controls in place in some countries. I'm not so sure about Oman, but I think that's something that would have to be checked. But it's not as simple as a business just saying VAT is coming in, let's increase the price by 10%. I think first of all, they can't do it as VAT. So VAT, they can only charge 5%. But obviously, subject to these other regulations, they can increase the price, and then they have to charge 5% VAT on that higher price. But like I said, there are some controls in the form of local rules and regulations, as well as the competition.
Indeed. Yeah, I think the main point, yeah, the competition, and any business want to retain its competitiveness in the market will try to keep, of course, the prices of the products and services low as much as they can.
There's a question here as well. If services are provided from Dubai to Abu Dhabi, but rail estate is Oman, has the Dubai supplier to register for VAT in Oman, as both Dubai and Abu Dhabi are both non-residents, or will this be outside scope? It all depends on the type of services. So, as we mentioned, that the place of supply is normally where the place of residence of the supplier is. There are some exceptions and special rules in relation to certain services, and real estate is one of them. So where you have supplies which relate to real estate, the supply takes place, where the real estate is located. So this is the rule you're referring to. So in this case, both the supplier and recipient are in the UAE, but the real estate is located in Oman. So now, if this falls within a supply of a service which is related to real estate, then you would have to register in Oman and account for VAT. And it all depends on the type of service it is. So it's not clear from your example what the service is, because maybe, for example, under the local law, it's not related to real estate. Maybe it's related to real estate in UAE and also Oman. So you could have a situation. It just all depends on the definition, which may result in some arbitrage. But I think the first question you have to ask is that if the suppliers in Abu Dhabi supplying to, sorry, if the suppliers in Dubai supplying to Abu Dhabi, then from a UAE VAT perspective, it's a place of supply in the UAE. So you have to look at the real estate provisions in the UAE, and depending on the service, if it is a real estate related service in accordance with the UAE VAT legislation, then you essentially you don't have to account for VAT in the UAE. It'll be outside scope from the UAE VAT purpose. On the other hand, if it's not considered a service which is related to real estate from a UAE perspective, then essentially, so if it is, then you have to account for VAT. And then you have to separately look at this from an Oman perspective, that, in accordance with the Oman law, is it a service which is related to real estate? And the definitions may be different in Oman and UAE, which is why I'm making this point. And if it is a real estate related service under the Oman tax law, then you also have to register and account for VAT in Oman, potentially. So that's the answer for that. I think that's it now. There seem to be just a few more questions, but happy to sort of address any more questions. And as you'll see, I think we'll share a copy of our slides, and my email address is there. So feel free to share any questions, or send any questions through later, which you haven't been able to ask now, or something else that you needed any clarification on. So hopefully that was productive for you, and I'm sure Joe will be sharing some feedback forms. It'll be helpful if you could complete these feedback forms, so just as a future reference point. And in due course, I think we will be hosting another session, just to give you a bit more specifics. The focus of this session was really to give you a flavor of what's coming and what you need to do, which is more important right now than the detail.
Yeah, I mean, if the implementing regulations might be issued by December 2020, that's the rumors, not sure yet, but it is issued within 6 months. So we should be watching for that, and hopefully maybe another webinar can organize for that.
Ahmed, you raised an interesting point. I mean, according to the law, the executive regulations are required to be issued within 6 months of the law becoming effective. So we're talking about, another year from now. But I'll be surprised if that happens. Obviously, I'd expect the regulations to come before that. And if not, I think that, you know, a lot of detail will come through, you know, before the law is actually implemented, and this detail may be in the regulations. It may take some time to finalize, but I'm sure the tax authority will be sort of ahead in terms of making sure that people have the information which will impact them. In the UAE, for example, the regulations were issued towards the end of the year. If I remember from memory, they were issued in November, and the law was effective from the 1st of January. But even a lot of articles which I did back in April had a lot of detail from the regulations. Okay, unless there's anything else you want to add, Ahmed.
Yeah, just I want to thank everybody who has attended this webinar. It's really nice, of course, to share our insight and knowledge. And thank you, Shiraz, of course, for giving this presentation. And hopefully we are going to give further presentation in the future in relation to VAT and its implementation in Oman.
Thank you, everyone. Thanks, Ahmed.
Thank you, Shiraz.
Thank you. Bye-bye.